Welcome to the Comply and Outperform webinar series, where we explore the challenges, opportunities, and innovations shaping the AML and KYC landscape. Hello, my name is Stephen Platt. Welcome to another edition of the Comply and Outperform webinar series from KYC 360. I'm delighted to be joined today by my colleague and co-founder, Tom Devlin. We're going to talk about Customer Lifecycle Management, or CLM, which is the acronym, what it is, why it's so critical for the finance industry, and how new digital solutions such as KYC 360 CLM solution are occasioning a paradigm shift in the way in which customer relationships can be managed on an ongoing basis. Tom, good morning. How are you today?
Very well, thanks, Stephen. Delighted to be here.
Good. Tom, let's start then with CLM. I mean, a lot of our listeners will know what customer lifecycle management is, but many perhaps will be less familiar with the concept. So would you mind providing us with a bit of an explanation and an introduction to this as a topic, please?
Sure. So CLM as a information technology way of discharging obligations is a new way of doing a very old thing. Really, since there have been fin crime regulations, there's been a requirement to manage ongoing monitoring of customer relationships. And for most of recent recorded history, that has been done in a pretty manual way, assisted sometimes by tools such as Excel and Outlook. And the discipline of CLM from a software perspective is bringing orchestration to that task to leverage benefits for organizations ranging from customer experience on the one hand to operational efficiency on the other, essentially enabling you to do more business with the same amount of resource while simultaneously improving the experience for your valued clients.
Okay, so managing the customer relationship throughout its life cycle, however long that might be, is a regulatory obligation. Clearly, you have to due diligence the customers at the onboarding stage of the relationship, and then you are obliged to manage the risks inherent in every customer relationship, as it were, for their duration. And CLM is the process by which you essentially do that as a regulated institution. That's right, isn't it?
That's absolutely right. And I think we perhaps focus as humans on the stuff that we can measure when it comes to AML. So there is this almost a fetish around the identification of individuals because it's the one chunky bit that we can do by reference to documents, and there are kind of easily achievable metrics by which it can be done. But in fact, as you and I well know, Stephen, that's only one small part of the process of really understanding a customer relationship with a view to identifying unusual or aberrant behavior which may indicate that it's being abused for criminal purposes or indeed for the laundering of criminal proceeds. And if your process or if your slick process kind of stops at that first identification stage, then it kind of fails at the first hurdle, because you're not going to have the level of dynamism that is really needed to understand, okay, I've onboarded this customer, Joe Bloggs, and I think I know something about him. Is his activity going to meet that expectation? And so CLM as a discipline, as opposed to as a kind of software solution, but just as an abstract discipline, it provides you with the framework in which to do that.
Yeah, I mean, you make a brilliant point, which is that there has been a lot of emphasis on onboarding and the digitization of the onboarding process within industry in recent years. And it clearly is really important to be able to do that well, because you only get one opportunity to make a first impression when you're onboarding a customer, and you don't want drop off and so on. But unless you've got a business model which has an extremely high turnover of customers, the onboarding experience only affects actually a very small percentage of your overall customer base, because most of your customers will have been onboarded before you introduced a digital onboarding solution. So the majority of your customers are being managed, as it were, by your CLM process, whatever that might be. And for those businesses that have introduced a digital onboarding solution, the reality is that most of their customers are still interacting with them via periodic reviews or whatever other aspect of CLM they're subject to, in a manner that's actually quite analog by comparison with the journey that the newer customers would have gone through as part of the onboarding process. And so that, I can imagine, is a big problem for organizations, because if you've been onboarded by a bank and it's been a really great experience, and then you go into the CLM process and it's very analog, and you're being asked the same questions over and over, and you are perhaps having to fill out manual forms or whatever, then there's an inconsistency there. And I can imagine that that could be problematic for a lot of organizations. Am I right in that?
I mean, I think it's immensely frustrating, right? And we all know this. We're all customers of financial institutions. Everybody listening to this webinar will probably have experienced this in their personal banking relationships,
Yeah.
and more so if they happen to operate business banking relationships. And I think, you know, your point, Stephen, is a good one, that actually the gap gets larger if you do succeed in having a slick onboarding process, because expectations are raised, hopes are elevated, and then dashed when the letter
Yes.
comes through the post or
Yeah.
the email comes saying we've got to give us these 20 different pieces of information. And I think the wider context is really interesting here, because historically, you know, banks, say banks, but this applies to all financial institutions really.
Mm-hmm.
In most part, they've not had to worry too much about this, because customer loyalty used to be a big thing, right? You know,
Yeah.
you got signed up as a child for a banking service, maybe with a novelty money box or something.
Yeah.
Or if that didn't work as a student, you might be offered a free toaster or some such inducement, in the hope that, rather like, you know, the brand of toothpaste that you use, the habits that are set when you're 6 or 16
Yeah.
remain for life.
Yeah.
And with the advent of lots of different things, so you know, moneysupermarket.com and similar sites,
Mm.
with the advent of challenger banks and challenger financial institutions that have made it much easier to switch, and with the switching sites kind of encouraging people to do that to get the best deal, that customer loyalty can no longer be assumed.
Yeah. No, it's a good point. I mean, you know, it used to be one and done, right? It isn't anymore. And as you say, you've got the big challengers that pose a really significant threat. I mean, that leads us on, I think, to an interesting point, because in the world of financial services, the the product, the service is highly commoditized, right? And there isn't that much margin. I mean, yeah, you can innovate, but actually the scope for innovation is pretty limited. You know, when one talks about bank accounts or investment accounts, whatever the case may be. So you're pretty limited when it comes to innovation. So what you're then left with in terms of the levers that you can pull in order to be able to gain some competitive advantage are, well, your risk appetite. Well, you know, but you're going to clearly not want to sail too close to the wind. So how much movement do you really have there when it comes to risk? Beyond your risk appetite, you've got cost to serve, you've got speed to serve, and you've got the user experience, the customer experience, and how good that can be. They're three levers. And I guess the right onboarding proposition, the right onboarding process, and the right lifecycle management process can really help you with all three of those, the cost issue, the speed issue, and the customer experience throughout the life cycle of the customer's relationship with you as an institution. So this is important, not just in being able in allowing you to demonstrate, as it were, compliance. This is actually really important from a commercial standpoint for organizations as well, because if they get this right, they can put some clear blue water between themselves and the competition.
It's the trifecta, right? Those three things. But actually, I think that you're underplaying the importance of the fourth, which is the one that you mentioned first,
Mm,
your risk appetite.
mm.
Because all of those things in some way hang off the risks that you're willing to take and accept as a business.
Yes.
And if your approach to risk is monolithic, where you don't
Mm.
have a lot of discretion, you can't tailor your services to different customer profiles, then the experience for customers is going to be kind of jerky,
That's
unpleasant.
an excellent point. That's a really good point.
And also it's going to hit your speed to serve and your cost to serve because
Yeah.
you're putting people into huge brackets
Mm.
when you could, if you really embrace the risk-based approach, have much smaller kind of bespoke categories for people where you're asking them for just the amount of information that you need and no
Yeah.
more. So you're giving them a good customer experience, but nonetheless covering your compliance objectives. And I think the reason this is so important is that in business, as in life, my observation has often been that the greater returns come when the risk level is slightly elevated.
Yeah.
So if you set your face against doing business with any risky customers because it's just too much hassle, that's fine, but your returns are probably not going to be as good as they could be.
Yeah.
Equally, if you take on too much high risk business, that's also a problem.
Yeah.
So being able to manage it in an effective way through that embracing of the risk-based approach, if you're able to do that, does, I think, give you some wiggle room on your risk appetite, and in turn, then improves the other three levers that you mentioned, so that
Yeah.
the overall outcome,
Mm.
if you're able to kind of start and accelerate this virtuous circle, is that you can onboard clients more quickly. You can reduce your own cost of servicing those clients because you're only doing the risk mitigations that you actually need based on their specific characteristics. And the overall experience is improved as a result, and therefore you do more business and you lose less business because
Yeah.
everything we've said about onboarding applies, but doubly so to the ongoing experience of the client.
Yeah. So if you embrace the risk-based approach through a sophisticated stroke digitized CLM solution, that is likely to translate into a much improved customer experience, which is then going to engender greater stickiness, and greater commercial performance. I mean, that's essentially your point. But I mean, look, everybody, Tom, we know this. Everybody talks about the risk-based approach, but very few organizations, in my experience, actually live it. I mean, um, in most organizations, it's simply interpreted as meaning we need to do more with higher risk customers. It's not interpreted as um, we're justified in doing less with the vast majority of our customer base, which is lower risk. Um, and uh, and we know actually that that is possible. I mean, if one interprets the risk-based approach in the right way and you're utilizing tools which enable you to genuinely take advantage of that, there are huge advantages, not just for you as an organization but also for customers, without you compromising your risk stance as a business. So how does a CLM solution, a digital CLM solution, cater to the risk-based approach? How does it allow you to take advantage of it?
I think to answer that question, you've got to think about the status quo ante, like the current approach in
Yeah.
many businesses, although not all. Because in some ways, what a new CLM solution offers sounds so blindingly obvious that it's difficult to understand why, as an industry, we haven't arrived at this point many years before.
Yeah.
And there are see some honourable exceptions. I know there are some banks that have good in-life monitoring technology and have invested in it.
Yeah.
But the vast majority of the places, Stephen, that you and I have visited in our professional career are still using Excel for their risk scoring.
Yeah.
Unless you're talking about retail bank scale, you can't really do that, but anything smaller than that. And the corollary of using Excel is you need a human to work it.
Yeah.
And the corollary of that is that you can't be doing these risk assessments very often because
Yeah.
otherwise you do nothing else all day long. So
Yeah.
in many
And
places,
mm, mm,
that risk review, the recalculation of risk
mm,
is happening only at the periodic review point, which could be 3 years or 5 years after you last looked at that
yeah.
relationship.
Yeah.
And if something's happened in the meantime, if there's been a transaction monitoring alert or there's been a sanctions hit or there's been some other unusual activity, well, maybe that's been picked up.
Mm,
Maybe it hasn't, because where you've got disjointed systems, there is always room for things to fall between the cracks. So I think before we consider what a good CLM solution would do, we have to think about what the current practice is, which
yeah.
is to say, you know,
It's a
in many
pretty low
ways not,
bar.
yeah, it's a low bar, right? And
Yeah.
I completely agree with what you said earlier about the risk-based approach. This is something that I've advocated for a long time, that if you are in compliance or in operations, it is your friend.
Yeah.
It gives you the license to be creative and ironically to take what may feel like taking a degree of risk with how you do your supervision.
Yeah.
Just in the sense that it's a departure from the one size fits all approach that many people have been used to. But in fact, what it offers is not really risk if it's done properly, but opportunity.
Mm,
And that opportunity is to be much more light touch with your lower risk customers,
yeah.
reducing your cost to serve,
Yeah.
reducing how intrusive you are into their lives, without reducing to any meaningful extent the level of assurance that you're able to gain in relation to those customers. And it then frees you to focus on the higher risk ones who, to my earlier point, are often where the greater rewards are to be found
Yes.
commercially. So, it's not easy or possible to really do that, to embrace the fruits of the risk-based approach, unless you've got some means of actually discovering fairly often, I would say daily, but
Yeah.
certainly more frequently than once every 5 years, what the risk profile of each of your customers might be.
Yeah.
So I think we start with that heuristic of this is what's gone before.
Yeah.
Then we can think about like what's possible, what's desirable in the future.
You're right, because the current utilization of Excel spreadsheets as the primary mechanism for managing customer risk during the life cycle of relationships means that in practice you can't be granular in your approach. I mean, everybody essentially gets treated in the same way. I mean, that's the reality. There can be some differences, such as, well, what is the frequency of review, depending upon the risk profile of a customer, but often the sort of nature of that review and certainly the quality of the assessment of the review is is oftentimes very similar. And I note, from looking at the anatomy of many of the AML sort of scandals that we've seen over the course of the last 2, 3, 4, 5 years in industry, that a failure really to apply the risk-based approach in any meaningful sense to high-risk customer relationships, which have then transpired to be problematic, has been a feature of many of those scandals.
Yeah, I mean it's analogous to kind of grade inflation in
Yeah,
education.
yeah,
He who praises all praises none. If you treat everybody the same, then you're not going to be able to differentiate. So actually, there is
exactly.
this small cohort that we need to look at in a much more intensive way. And by the way, we can justify doing that and we can afford to do it because of all the money we've saved in being much smarter
Yeah.
about how we deal with our low risk population.
But I mean, I used to be very amused back when we were doing the Section 166 style investigations. I mean, how many businesses did we speak to about what we perceive to be the absence of appropriate management of high risk customers? Um, uh, and to be then met with the response that, oh no, we have been managing them appropriately. There's no distinction between the way in which we manage them and lower risk customers, because we just treat all of our customers as if they're high risk, so they all get, as it were, the royal treatment. And so, it's just this, always struck me as being pretty nonsensical. You have to demonstrate a clear difference in your treatment of customers depending upon the risks that are inherent in those individual relationships. And a digitized CLM solution is clearly going to be more adept at allowing you to demonstrate that than a manual system based off Excel spreadsheets.
I mean, I think we're at a really exciting point personally, because the ability to calculate and recalculate risk scores for customers is nothing new. That's been
No.
around for quite a while in various
Yeah.
different forms. And it's something which every institution of any size should be doing as a
Mm.
matter of course. There should be a daily rebasing of risk for customers. But what is changing with the advent of AI is our ability to make sense of the data that is produced
Yeah.
in result of those calculations, and to sensitize any alerting that we might have appropriately, so that
Yes.
only the stuff that is actually genuinely salient and relevant is elevated for human review. We've not really had that in the past. And so one of the disincentives to monitoring, unless you really, really had to do it, was it could be very noisy. And the result of
Yeah.
that noise could be ultimately disillusionment and cynicism among your staff, because if you didn't calibrate it well, a very high percentage of those alerts are false positives, and then people
Yeah.
get complacent. Then they miss
Yeah.
the actual real stuff, which is obviously the worst position to be in. But I think AI helps also outside of the four walls of the business that is using a CLM solution, because with AI, we are seeing more and more external data being marshaled
Yeah.
by vendors like Cyari and others that we work with,
Mm.
and dots being joined together in a way that wasn't previously possible. There weren't
Mm.
enough kind of human analysts to do it, such that while we're not quite there, we are now approaching the point where it's realistic to say, I can have a corporate customer and I can be fairly confident that I'm going to be notified in real time or approaching real time if there are changes in ownership or structure that have been
Yeah.
declared.
Yeah.
That's
Yeah.
not been possible before. And we're getting to that point. And there's a host of other areas where um, AI and the profusion of data vendors that have come off the back of it are making it possible for us to have a truly live view of customer risk, as opposed to what we've had so far, which is one where you can recalculate every day, but you're recalculating against only a small set of parameters. So
Yeah.
unless something very seismic changes, you're still not that much further forwards.
Mm. No, it's really interesting. Tom, look, we've talked about customer experience and the levers and how the experience that customers have in the way in which they are managed throughout the life cycle by their provider is so important. But this is also an area that is of vital importance to operations. There are big wins here for institutions that embrace these solutions from an operational perspective, because most of them, operate on pretty predictable margins. Um, and I think that there's a recognition of, the escalating cadence of periodic reviews, which, which is done by, you know, sheer willpower and by throwing a lot of bodies at the issue. That clearly costs a great deal of money. It costs a great deal of time. It causes a lot of anxiety for um, customers, for intermediaries of ultimate customers sitting behind different structures, um, which often can actually enrage them. I mean, you can see a lot of churn as a consequence of a KYC remediation project or a periodic review exercise. And worst of all, the way that it's been done historically through a lot of manual intervention, through a lot of bodies managing Excel spreadsheets and so on, as you described earlier, worst of all, once you've finished that project, you're probably likely to have to repeat it in 3 or 4 or 5 years' time if you don't have a CLM solution, which is going to allow you to continue to monitor risk and rebase that risk dynamically from day to day. So, from an operational perspective, where industry's at the moment is a position of huge inefficiency, and what we're saying is that there could in fact be massive operational efficiency gains by embracing this new approach.
I mean, I think that the cost of losing your more valuable customer relationships, because the most valuable customers tend to be the ones with the most options, typically.
Yes. Yeah.
Is massively underplayed and underappreciated when weighing the overall benefits and debits of the current approach. It's easy if you're sitting in an operational role to look at the bottom line and say, okay, just in staff costs, this is taking me X thousand hours per year of productive time away from people who could be doing more important jobs for my institution. You can see that. But the revenue that you could be losing, the leaky bucket, the hole in the bottom of your bucket that you're creating by doing this badly, is in many ways more salient. You and I both know, Stephen, that once you've gone to the enormous effort of winning a customer, the most critical thing is making sure that you keep them and keep them happy, because then you've got dependable revenue, year in, year out.
Absolutely.
And I think when this is done badly, it does open that door to the customer saying, right, I'm tempted to leave. Periodic reviews in general, I don't know about you, I don't think I've ever been into an institution of any size where the periodic review schedule is on track, and we're kind of everything's being done on time. There's no backlogs.
There's always a huge backlog. And again, to reference once again some of those scandals, it's always a feature.
Yeah, because once you're kind of overwhelmed, you're going to miss stuff, or there'll be pressure to do things in a way that isn't the correct way. And this comes back to ultimately poor organization. There are easy ways to do this better. If we think about what some of those might be, so coming back to the risk-based approach, if you've got low-risk customers, we've seen quite a number of institutions making the argument to their regulator and succeeding in making that argument that where the customer is low risk, their activity is low risk, it should be permissible to satisfy any ongoing KYC requirement, absent some big event in the customer's life cycle, by way of a non-documentary check on the customer. And that has myriad benefits. There's no outreach to the customer. You don't need to even tell them that it's happening. The cost is very modest. The speed is instant.
Yes. And
if you've got 100,000 customers and it works successfully for 90,000 of them, then you've got a much, much smaller cohort of 10,000 that you've got to contact and do something with. Whereas previously you would have had to contact all 100,000 every 3 years to do your validate and sort of update and so forth.
That has the additional benefit of allowing your staff, your people, to focus on genuinely value additive work and to put their attention on those customer relationships that do present higher risk and which genuinely require the analysis.
Yeah. Well, I think also that the kind of role of policemen, which financial institutions are obliged to perform, is one which is ultimately done in dialogue with regulatory bodies. There is a kind of flow backwards and forwards of higher or lower expectations as to which parts of this job the FIs should carry out and how they should go about that task. And I think that some of the more successful institutions over the last few years, and certainly I would expect this to continue, are those who've been able to reach a pragmatic accommodation with their regulator and say, look, to your point earlier, it doesn't make sense to treat all of our customers the same way. The risk-based approach has to mean that there is some benefit in differentiation for us. Otherwise, what's the point of it? And I think we could quite quickly see in some sectors the ability for industry to make this ask to their regulator to say, look, I've got this foundational building block, which is live risk scoring of my underlying base, which I trust. I've
Yeah.
tested it, I trust it, I know what's going into it. I've invested in this, so I have a better understanding of my customers. My ask to you as the regulator is that you now give me the air cover or the permission to move to a genuinely event-driven review process.
Yeah.
Because, frankly, for a low-risk customer, there is very little value in asking them to provide you with an updated copy of their passport. It's
Yeah.
unlikely that they will have changed who they are in the intervening time, unless you see some activity marker that makes that less plausible. And that's the really, really big win here, because if you advance to that point, not only are you winning permission for your institution to say, for most of our customers, we will monitor internally, but we won't need to do a formal review process unless something changes.
Mm.
But also the flip side is when something does arise, if it looks like an account is being used by a money mule or there's other activity that's not expected, you've got the resource to deploy. You've got the people who
Exactly.
are motivated and they're using their brains for the things you hired them to do, rather
Yeah.
than the kind of repetitive, mind-numbing process of formulaic reviews into the 99% of customers who are not bad actors and who you can show to a good standard are very unlikely to be bad actors using all that technology that you bought.
Yeah. Because it is a win-win-win. I mean, non-documentary verification for lower risk customers does not weaken your risk stance. In fact, it enhances it because you have got a form of verification which is instant, as opposed to the current situation in which, for the majority of your customers, you're in a backlog position because you haven't done a periodic review for the last 24 or 36 months. So it's a win in the sense that your risk stance is strengthened, number one. Number two, it's a win because your customers are happier. And number three, it's a win because operationally, you have taken advantage of enormous efficiencies. So clearly it makes a great deal of sense. And number four, it's a win because those resources that you do have, as you say, can be focused on those relationships that genuinely pose a risk of financial crime, exploitation of your organization. So it clearly makes a great deal of sense. And industry, I think, is beginning to wake up to um, this 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 shift and to the art of what could be possible by embracing these solutions. Now, Tom, you've been super involved in the design of our new CLM module. What are the highlights of that module? I mean, what makes it different? What makes it better than the competition in your view?
I mean, I think there's a number of things, and I would start by saying that at KYC 360, we've operated a CLM capability in a different guise, an
Yeah,
on-prem guise, for the last 10 years. So
yeah,
this is something that we're really quite expert at, and we've had a lot of customer input on our current solution, which has helped us to design the new one.
mm,
So key things, most important characteristics, I would say. Number one is around the risk scoring itself and how that's done.
yeah,
So in our platform, you can have multiple risk models that apply to the same customer. So you're tracking not just AML risk, but operational risk, ABC risk, sanctions, tax, any other sort of areas that you want to manage. And this is important for two reasons. The first is that it's giving you a rounded picture of the customer relationship. But
yeah,
also, if you are someone on the compliance or risk management side who's wanting to buy a solution like this, and you're looking to get support from your colleagues, it
yeah,
helps to solve other problems within the organization as well. So that's the first thing. And what underpins that is a very, very strong data model.
yeah,
So we keep a track of all the data that has been entered over all time about a particular customer,
yeah,
which means that we can show you not only what the risk score is today, but what it was a year ago, 2 years ago, 3 years ago. And in
Yeah.
doing that calculation, we're using the data you had a year ago and the risk model that you had a year ago
Yeah.
versus those two things today.
Yeah.
And that is massively important for the kind of, if you like, the meta benefit beyond just periodic review enhancement, which is showing your organization's progress
Yeah.
towards your business risk assessment
Mm.
goals. Or
Yeah.
indeed, if you're going in the other direction, you can identify that
Indeed.
trend and do something about it. So that's the first thing, and that's really, really important. Um, the second thing is that we've built a absolutely world-beating periodic review flow within the platform. So this is a flow where you can configure your own periodic review questionnaire according to the things that are important to your organization. You can then view all of the underlying data that is relevant to that review and nothing
Yeah.
that is not, in a kind of nice packaged way. You can have automated outreach if you need it, if it's justified, with a nice kind of branded, responsive, dynamic form that will ask your client only for the stuff that you genuinely need, not the other stuff that you already know or don't need to
Yeah.
collect. And you've also got the ability, and I think this is super important, to have a casual outreach process. So if you look at the record for Jane Smith, you see that on her record there are 30 data points you've got to look at. 28 of them are fine, but there are two of them that require improvement.
Yeah.
You can, on the fly, just kind of nominate those two things and say, right, I want to create a kind of bespoke request out to her.
Yeah.
And in a couple of clicks, it's done, and she will then get a beautiful form that only has these two questions
Yeah.
in it. And that kind of level of granularity is what really drives success. And I say that having studied a number of institutions who've been in the midst of periodic review or remediation exercises and
Mm.
looked at the areas where they burn time.
Yeah.
And I can tell you that the biggest areas where they burn time almost universally are, number one, a request out to their customer that is generic.
Yeah.
It's not bespoke, which means not everything in it is going to apply to that particular customer, and that then leads to uncertainty on the customer's part, and then potentially not providing back what's needed.
Yeah.
That's the first thing. Second thing is when you do get the response back in the generic model, somebody, a person, then has to analyze that response and try and tie it back to a policy and procedure document somewhere to work out, have I got what I need? And are the
Yeah.
documents that I have adequately certified and all of this, right?
Yeah.
Okay.
Yeah.
And surprise, surprise, quite often you haven't got exactly what you needed because you didn't ask the question in the right way.
Yeah.
And then the third thing, and this is what really, really burns productivity when it comes to reviews,
Yeah.
is rework. So you've
Yeah.
identified you
Exactly.
didn't get what you wanted. You've got to go back out to the customer. They are enraged because they're already cross with you because they've had to
Yeah.
do this onerous exercise. And now you're telling them they've got to do more of it.
Yeah.
And at this point, you may well end up in a sort of unseemly dialogue
Mm.
where either your customers just, they've deprioritized this. It's not their priority. They gave you what they thought you wanted. So,
Yeah.
they'll get to it in 6 months if they can. And you're
Yeah.
just left hanging. Or you've got to start sending them threatening letters saying, if you
Yeah.
don't do this within 15 days, we're going to shut your account, which is
Yeah. Or we're going to
terrible.
freeze you out.
It's a
Yeah.
terrible, terrible look.
Yeah.
So,
And the scope to damage the customer relationship in this phase is, it's very real.
yeah.
So,
I'd say it's the most dangerous point in the life
mm,
cycle with a customer
mm.
because you're asking them to do something for you. And unlike at onboarding, where there's a perceived benefit, which is I
There's
get
no
to access.
benefit to them.
No,
No.
no, none at all. So anyway, coming back to our platform, we've studied this process very closely. We have automated every element of it that we can, and
Mm.
we have tooled the system so that it's ready for those institutions that are ready to move to a review process where before the review even happens,
Mm.
system has checked that all the required information is present. If there's anything missing, a very nice, completely bespoke request is sent to the customer or a third-party data provider to fill in that info, so that when your staff member comes to do the review, it is literally that. It's a review of the
Yeah.
stuff that's already there. It is
Yeah.
not the current kind of foraging exercise to try and find the data, and then analysis to see what's present and whether it's adequate or not. It's the reverse of that. So we expect to see enormous productivity gains off the back of this.
Yeah. I mean, we're going from a sort of a current process, which is really blunder busting, to one which is better for everybody concerned. So look, Tom, I've really enjoyed the discussion. We don't actually, even as colleagues, we don't often get the opportunity to sit down and have a chat of this type. So I've enjoyed it enormously. For those listeners, if you're interested, obviously, to learn more about KYC 360's CLM solution, then Tom will be running a demonstration, which I hope this will have whetted your appetite to see. And obviously, if you'd like to talk to us at any point about your particular challenges when it comes to managing the risks of your customer relationships on an ongoing basis, we're always delighted to talk to you and to ascertain whether or not we may be able to help you to alleviate or overcome some of those operational challenges with which you might be faced. But for today, thank you very much for listening. Tom, thanks so much for your participation. I enjoyed it. Over and out. Thank you. Thank you for attending today. We look forward to welcoming you on our next Comply and Outperform webinar.